This market volatility has been fun to trade only if you know the right levels to watch. In this video, I'll share the levels that I'm looking at inside of the S&P 500, the Dow Jones, the Nasdaq, along with IWM for shorter term bounces, along with places to take advantage of this volatility. Let's start with the S&P 500 first, and as we go through this video, you'll notice that I'll start with the daily time frame first before moving on to the weekly and the monthly time frames to take a look at creating a game plan for this volatility in essence. Now we start first with the S&P 500. You should notice a lot of lines on my chart, but let's summarize this first with just some key clusters. The first cluster, the first support zone, represents about a 10% drop in the S&P, where we expect that sell side activity to subside. That's right now. After that 10% decline, I have the next level closer to a 17.4% decline, then closer to 25% before we have some open gaps, which should give us nearly a 40-ish% correction inside of the S&P. Now the open gaps down here seem unlikely to get filled, but I think the shorter term levels are much more likely and in fact tell you where the S&P has actually gone before. These red lines represent Fibonacci extensions where I'm comparing past swings to see where is that likely to take the price currently. For recent term price action, that gives us this zone, which that zone is right near 563 to 553, and we're inside of that zone right now. Now, these aren't perfect science levels. In fact, before I switch to the other time frames, if I show you the Dow Jones, you should notice how the Dow, we've broken these extension levels. I'm okay with that. All these extensions are doing is telling me where is this particular market likely to fall to, and what is that on a percent basis. So in the S&P, again, this represents about a 10% drop, which to me represents a healthy place for buyers to step in for the first time. Now, I think there's likely to be some slippage. The way the volatility is currently looking, it feels like we're in this negative gamma type of environment looking to take out a lot of stops. So that leaves me looking for 550 to be tested with all stops below this current wick to be taken out. So I think these levels give us a place where price will stop, but not an exact science. If we switch to the weekly time frame chart here, notice how we're starting to see these red candles form. This is where our candle counter indicator that we built comes into use. You'll notice on average we can see about 7 max weekly candles, and so far we've seen just about 4 red weeks. So that tells us we can see up to 3 more red weeks, and this has been over the past 20 years, and that would be perfectly normal. 3 more red weeks could take us back down towards this 520 level inside of the S&P, which would represent closer to that 14-15% correction. Again, healthy territory and gives us a gap fill near 535. So the weekly chart all suggests a little bit more downside. Now we come into the monthly chart. And if you take a look at the monthly chart here, you have the red edge signal arrow suggesting we're now in overbought territory, looking for at least price to revert back to the mean, at least take a little bit of a breather. And on the monthly chart, that mean gives us a price close to about 538.33, again overlapping nicely near this 522.81 level. So near term, short term 522.81, the major level I'm looking at, come back into the daily time frame, feels like that one will be in our next leg down lower. So that's the S&P 500. Now we switch to the Dow. The Dow is particularly interesting also because some of the intraday volatility opportunities it's been giving us. Here's an example from yesterday. We had price action fall inside of our volatility box models. These are the daily volatility box models. You can see how price stabilizes here before buyers pick in. This is in essence an example of how I'm looking to take advantage of this volatility in conjunction with our levels. These were the levels that we had inside of the Dow, near 418, 417, and as soon as we cross below, now I'm looking for a volatility edge to try and get long. We're also towards the bottom of this trend channel, which to me leads to a reason why I'm looking for a shorter term bounce back up to 420 before price falls back down, fails to about 400 with all the negative gamma false breakouts. 400 would simply be about a 12% correction inside of the Dow, which feels fairly healthy. Same thing if we come into the weekly time frame chart here, we have the 400 level and then our next set of levels near 374 and 368. That gives us a drop. If we came to 400, we said about 12%. Further down, about 17%. Open gaps take us down to about the 20% territory inside of the Dow. All very healthy corrections. On the weekly time frame, we've also seen that momentum, this time for the second time, has crossed to the downside, again suggesting we should see more sell side pressure. That should be completely expected based off of the technical signs we're seeing. And on the monthly, one more time, we're seeing that overbought signal, but this time on such a large red candle that it feels likely to see a short-term bounce before actually seeing the effects of that candle. Next up, we go to the Nasdaq. Going to repeat the same process daily, weekly, and then monthly. The daily time frame chart, we have these levels down here, which also overlaps nicely with our 1272. Call it a cluster from 467 down to about 438. Seems like a fairly wide zone, but in the end, really, we're saying about 13.55% to about 19% correction inside of the Nasdaq, where you should expect more volatility. So here we have more of a wider range as well, where we expect to see that fluctuation. 450 in this feels like the most likely area, at least a place where I'm looking at a similar type of bounce as what we saw inside of the Dow, but you'll notice here the Nasdaq nowhere near the same volatility as we saw in the Dow yesterday. Same thing inside of the S&P 500. So come back to the cues on that weekly time frame chart, and our momentum signals all suggest that we should start to see a little bit more downside, maybe some slippage to 450 before again seeing that shorter term bounce. On the monthly time frame chart inside of the Dow, same idea as what we're seeing in the other index markets. We're seeing the overbought signal. So this time across 3 index markets, all near Fibonacci levels, we're seeing the overbought signal. Now finally, we have the Russell, and let's start the conversation with the daily time frame. In the Russell, there's a few key clusters. The first cluster represents about a 20% drop. The second cluster about a 33% drop. So far, you can see how the Russell feels like we're headed right towards this 200 level and finding support near this level. That's where we'd expect to see that for the shorter term bounce before ultimately, if we come into the weekly time frame, gravitating towards that 170 area to fill some of the open gaps we have down beneath us. So if you notice now, we recap in everything. Across the board, we noticed a few key common characteristics. We noticed we were near some common shorter term supports, but we had much longer, larger, stronger supports beneath us. That suggests that I'm looking for a shorter term bounce before seeing our next leg lower, but that next leg closer to about Q3 of this year, not taking place in the shorter term. Our shorter term volatility all suggests we should see maybe a little slippage before seeing buyers step in, bring price action up, and see that volatility essentially go back and forth as we head into March expiration. I hope you found this video helpful for those of you looking for some specific price levels that you can use to take advantage of this volatility. Take care, everyone. Good luck trading, and I'll see you in our next update.